What's up, guys? It's Paul here from the 9 to 5 Investors Club channel. In this video, I'm going to show you exactly how you can make a monthly income selling call options on a stock, almost like a covered call, but without actually owning 100 shares of a stock, okay? So essentially, this is a form of a credit spread, but in reality, what you're doing is you're actually buying leap options on a particular stock that is potentially very expensive, and then you're going to sell monthly calls against it, okay? So this is exactly how that's going to work. So let's say you have a stock like Tesla. In order for you to sell covered calls, which is one of my favorite strategies if you've been watching my videos, you would need to spend $53,000 to first own 100 shares of Tesla, okay? If you have that kind of money, or if you already own 100 shares of Tesla, you're good. But let's say you don't have any shares, or you just have 20 like I do, but I don't have enough buying power to buy 100 shares of Tesla. Here's how I would do that, okay? So you click on trade Tesla options. You would buy what are called leap options, which are typically at least a year or more. But I'm going to choose September 2021 just as an example because we don't have a November 2021 expiration available yet. So just as an example, I'm going to choose September 2021. And what you would do is you would either buy an in-the-money call, like a 500 call here, for example, which is $14,000, which is still expensive, but definitely lesser than having to pay $53,000 to buy 100 shares. Or you can go slightly out of the money, for example, like the 600 call or a 620 call, which is closer to $10,000, okay? So even that's relatively expensive, but the way it works is you would first buy the 620 call. You're just holding it for the long term. It's $10,000, definitely better than $53,000 to own 100 shares. And then you would move back to a monthly expiration, say December 24th, because it's November 23rd today. And then you would sell, say, the 600 call or a 610 call against that leap call to make monthly income, okay? So you paid about $10,000 to buy that 600 call, and then you would sell this December 24th 600 call to immediately collect at least $2,060, okay? And you would repeat this every single month between December 24th and then January 15th and Feb 19th, every single month, depending on how Tesla is moving. You would choose a strike price that is usually around $600 because you want it to be relatively close to your leap option, and then you could potentially make $2,000 or even more per month just as Tesla appreciates, and you can keep collecting monthly income, okay? Now, at any point, before I say that, the stocks you have to choose leap options are stocks that you actually believe are going to do well in the long term, okay? So the ultimate goal is that over the next couple of months, you're actually expecting Tesla to be a $650, $700, or even an $800 stock by mid next year. That way, at any point, if you want to just stop selling these monthly calls to make an income, you could directly sell out of the September calls and make a huge profit on that, okay? So let's say by next May or June, Tesla ends up becoming an $800 stock. Considering how Tesla runs, it's quite possible. So let's say it does go to 800. That September 600 call could easily be worth between $20,000 to $25,000. Okay, so you would have made a 150% profit on that if you ended up buying it for $10,000, and on top, and you can add the monthly $2,000 that you collected leading up to that on these monthly spreads. Okay. Selling a call or a short-term call against a call that expires a few months out is actually called a calendar spread, which is usually a pretty effective way to make monthly income without actually having to own the underlying stock. But with leap options, you're essentially giving yourself more time to make more consistent monthly income, and you can absolutely close out of it at any point you like to lock in a huge profit. Okay, so this is a pretty good strategy that I use once in a while on stocks that I don't have 100 shares of. For Tesla especially, this is a great opportunity that you can use. I don't have 10,000 or rather I don't want to invest 10,000 for September to buy the 600 call yet, because I usually prefer shorter term debit spreads or credit spreads to make monthly income. But this is definitely a great strategy that you can use if you have the necessary buying power to buy in the money or slightly out of the money calls for a year or more out, okay? So that's mainly what I wanted to share with you guys here today. It's a very quick video. Just wanted to show you how you can use a calendar spread with leap calls to make a monthly income. It's actually also called a poor man's covered call, because for covered calls you at least need 100 shares of a stock to sell calls against it. But in a poor man's covered call, the way it's defined is you actually buy a leap call expiring a year out, and then you sell calls against it without needing to actually own 100 shares of the stock, okay? one other key factor about this strategy that you have to remember is, let's say you did end up selling this December 24th 600 call, and that's only a little over 10% away from where Tesla is trading currently, maybe 12-13%. Considering Tesla moved up 8% just today, it is quite possible that Tesla can run up to $600 leading up to December 24th, or maybe even before that, because the S&P inclusion is on December 21st, if I remember correctly. So if it does run up, you actually should make sure that you're actually adjusting your spread, okay? I posted a video just yesterday on how to adjust spreads, but just as a quick refresher, what you would do is, if you sold a 600 call, you would essentially buy it back and then sell a 620 call at a small price, okay? So if you got a credit of 2,000, to adjust it from 600 to 620, you may have to pay, say, $400, and that would reduce your initial credit from 2,000 to about $1,600. You could also roll it over from December 24th to, say, December 31st or January 15th at a higher strike price, so that you're giving it more time to appreciate and eventually probably come back down, so that it can actually expire worthless, okay? So the whole point of selling calls for credit is for them to actually expire worthless, so you always need to keep an eye out on it to make sure that you're constantly adjusting it or rolling it over to make sure that the stock stays below that strike price, okay? So I hope you find that helpful, guys. Please just smash that like button if you did. It's going to help out the channel a lot. Leave a comment below if you have any questions, and be sure to subscribe if you haven't already, and hit that notification bell, okay? Thanks again for watching, and until next time.